Hello guys, this is a trade review of all the trade ideas that are posted in the verticalspread.com forum for the June 2020 expiry cycle. And as part of the review process, I am going to cover or focus on my main rationale for putting on the trades. What prompted me to put on the trades and how did I go about selecting my strikes? I'll also talk about how I close out the position. Did I manually close the position or did my profit target get hit? I'll then move on to the profit and loss on the individual trades. And I'll also cover the overall profit and loss for the entire month. So I'm going to dive into the individual trade ideas now. For the month of June, I had 3 trade ideas in 2 underliers. So I had 1 trade idea in GLD. GLD is an ETF that tracks the price of gold. And I had 2 trade ideas in IWM. IWM is an ETF that tracks the US Russell 2000 index, the small cap index. So I'm going to go into the individual trade ideas now. The first one being GLD. I'm going to go into GLD now. So the first trade idea is in GLD. The trade date was the 11th of May 2020. At the time, GLD was trading at $159.62, and the implied volatility on GLD was 54. There were 39 days until the June contract expired when I put on this trade. And the trade I structured was selling the 154-149 put spread. And for selling that, I received a credit of $1.10. Once my order got filled, I set my profit target to buy back the spread at 50 cents. So why did I put on this trade? The main reason, the number one rationale, is the implied volatility. Implied volatility spiked in GLD, went to 54. I usually avoid selling spreads on underliers that has an earnings announcement or any known binary event within the duration. So in this case, anything over the 39 days that would result in a binary outcome. GLD being an ETF doesn't have any earnings announcement, so there was no earnings announcement to contend with. And I usually sell at least two strikes out of the money in terms of my strike selection. So GLD was trading at 159 and I sold the 154 put. So that is at least 4 strikes out of the money. And that's why I put it on. So on the 15th of May, which was, I think, 4 days into the trade, GLD, the price of GLD went to 164.36. It was a 159 when I opened it. And my profit target of 50 cents was hit. So I created a good until cancelled order to buy back the spread for 50 cents. And on this day, my order got filled and the position closed and I took my profit. The profit on this position was 60 cents or $60 per contract. And you get that by deducting the 50 cents I bought it back for from the $1.10 that I sold it for. And the P&L on risk for this position is 15%. And that is trade number 1. I sold 2 contracts on this position, so that would have been a profit of about $120. I'm going to move on to the second position, which is in IWM, and the third one is also IWM. So I'm going to the first of the IWM positions now. Right, so this is the second trade idea in IWM. And on this one, the trade date was the 7th of May 2020. And at the time of opening the position, IWM was trading at $128.21. Implied volatility was 50.9, and there were 43 days until the June contract expired. The trade I structured was selling the June contract 137.142 call spread, and for that I received a credit of $1.38. So my main rationale for this trade, like every one of my trades, is the implied volatility. 50.9 was quite high relative to where IWM's IV had been for the past 6 months, as of June anyway. And then I like to sell at least 2 strikes out of the money. IWM was trading at 128 and I sold the 137, which is about nine strikes out of the money. IWM is an ETF, so there were no earnings announcements due over the 43-day period for the trade, and I wasn't aware of any other binary event. So I put on this trade. I got filled for a credit of $1.38. I then set my profit target to buy back the spread at 50 cents. And then I created a GTC order, good until cancelled order, to buy back the spread for 50 cents. On the 14th of May, which was about a week after I opened the position, my GTC order got filled and I bought back my spread for 50 cents. When the position closed 7 days later, the duration of the trade was 7 days. IWM was trading at 121, and remember it was a 128 when I opened the position. IV actually went up to 65.5, but the delta move on the underlier helped to crush the premium, and I was able to buy it back for 50 cents. P&L on the trade is 0.88 or 88 cents per contract, and you get that by deducting the 50 cents I bought it back for from the 128 that I sold it for, and you arrive at $88 per contract. P&L on the risk in this trade is 24%. So 24% profit on the risk taken. The risk taken takes into account the spread minus the premium received. So that's the review of trade number 2. I'll be moving on to trade number 3, which is also a trade idea that was in IWM. And this is trade number 3. It's also a trade idea in IWM. And on this one, the trade date was the 18th of May. At the time, IWM was trading at $132.54, and implied volatility was of 54.8. There were 32 days until the June contract expired, and the trade I structured was selling the 141.146 call spread, and for that I received a credit of $1.30. The main rationale for opening this trade is same as the previous one. Implied volatility was high. There were no earnings announcements. My strike selection, I chose strikes that were at least 2 strikes out of the money. On this one, you can see the IWM was at 132, and I sold the 141 call, which is, call it $9 out of the money, the strike price. This particular spread didn't go according to plan, and I had to make a number of adjustments to reduce my risk on this position. I'll dive into them briefly, but I won't go into too much detail because it could get a bit complicated. But I'll cover it. I'll cover it now. Just bear with me. So the original trade idea I mentioned was selling the June 141.146 call spread, and I received a credit of $1.30. Well, things didn't go quite as planned on this one. And on the 18th of May, I decided to roll the spread. And I did that by selling the 135, 130 put, which I then bought back. I'll just go through the adjustment. So this is adjustment number 2. Adjustment number 1 here. This would be my very first spread, so I won't call that adjustment. My very first spread was selling the 141, 146 call spread. I made an adjustment to it by converting it to an iron condor. I sold the 135, 130 put spread and received a further credit of $1.22. The main reason for making this adjustment was because the market had moved significantly, and it had gone above my short 141 call. So I made an adjustment to defend the position, took in an extra credit, sold it for 122, finally bought it back at 28. Spread number 3, I rolled spread number 2 and sold the 146, 141 put spread for $1.07. I rolled spread number 4 into spread number 5. And then this one, I sold the 156, 161 call spread for 121. The net effect of all the various spreads came to this. This is the profit calculation on all the individual legs that make up this position. Minus 2.74 on one of them, plus 94 on one, minus 167 on one, plus 111, plus 103. The net effect was a loss of 1.33 on this position, which is much smaller than it would have been if I had not made any adjustments at all. So I sold the initial spread for 130. Had I not done anything to adjust it, my loss would have been about 370. So I managed to cut that in half and reduce my loss to 133. So those are all the 3 trade ideas I had for June. Let me jump into the overall P&L for the month. So the net profit for the month of June was a small net profit of $31. I'd call it flat. So June was not a particularly good month for my spreads, but I still managed to close out the month flat or avoid making a loss. Ended up with a tiny bit of profit. And that's because one of the IWM positions went against me, and I had to make a few adjustments to reduce my risk in the trade, and that resulted in me taking a small loss. Now, all these trade ideas are based on 2 contracts position size. So I was only trading 2 option contracts per trade idea. On the first IWM trade, I made a profit of $176. On the second position, GLD, I made a profit of $115. And on the second IWM position, a loss of $260. And that nets up to a profit of $31 per contract. So those are all my trade ideas for the month of June. June wasn't particularly a good month, but even then, still didn't lose any money. It just goes to show that with these spreads, you can make an adjustment and reduce your risk, and in some cases, you can actually reduce that risk and make a profit. In this case, I wasn't able to adjust it enough. But there you go. That's my trade review for the month of June. I look forward to seeing you next month. Thank you.